Hello everyone, Clifford Bennett, Chief Economist, ACY Securities, and I've got some breaking news. No one else knows about this yet in the entire world. Taylor Swift has a new album out. Oh, it's been out for a while? I just heard about it. Anyway, that is bound to cheer markets up because they're clearly in a very depressed state. Now, everyone in Australia today is talking about the budget, but the budget's immaterial, except it looks like energy prices are forecast to go up a lot for Australians, maybe 50%. Now, the reason I'm smiling is because we've been forecasting this for a year, and our leaders and central bank are just figuring all this stuff out and chasing it and acting like it's a sudden crisis, and how could they have possibly known? Well, lots of people knew, and we spoke about it and we wrote about it. What does this tell us about the global outlook for stocks? Well, in the US, Microsoft and Google have severely disappointed on their earnings. And look, I've got to say to you, and I've got an inkling I should use the word people. Listen, people. Look, people. But I hope you like my new style. Anyway, back to the point. What I'm trying to say to you is that it's not a short-term thing that we have inflation, that we have high energy prices, that there is a war in Europe that could intensify and expand. Remember, the danger period for intensification of the conflict in Ukraine is November, December. We wouldn't be buying stocks ahead of that period. Then there's a danger period December through February for energy supply in a cold winter Europe. These are not things to buy stocks ahead of. These are things to be really thinking on your feet and wondering how to protect your investment portfolio still. My point is that it's not this will be over in a couple of weeks, this will be over in a couple of months. This might not be over for 2 or 3 years. And it's been going for nearly a year now, this down move. It started in the first week of January, so 10 months coming into 11. You have to understand the world is in trouble. The global economy is slowing. German consumer confidence yesterday, disaster. We know European consumer confidence is at disastrous levels. UK consumer confidence has never been so low in its history. In other words, even for the depressed English, this is depressing. So why are other economists at some of the big financial firms in Wall Street trying to tell you the US economy is strong? We've just seen services in the US, the services sector, go into contraction, and we've just seen the manufacturing sector hit a 14-month low, and manufacturing in places like the Texas Fed and the Richmond Fed, their indexes for manufacturing, they've been in contraction for months. Retail sales are flat in the US. This is a very weak and worrying economy. On top of this, we have concerns about China still having a COVID-0 policy, an entrenched leadership style which has served the country well in many regards, but some people are skeptical about, so that's affecting sentiment. In Europe and the UK, it's just game over. Why people think that because a 42-year-old just got elected as the third Prime Minister of the UK in 3 months, that is a good thing for sterling, beats me. It just means it's a never-ending, ongoing crisis. So I'm being flippant, yes, because we've been saying this for, 10, 11 months. And we're actually saying at the middle of last year to expect this year. So we've said, play strong defense. Use all the financial instruments that you have at your fingertips. You've never had a better opportunity to protect your wealth. I mean, I've had some friends that I advised earlier in the year, and they, in their own decision-making, sold all of their stocks. Look how well they are sitting now. So I do think there's a couple of good trades though. I do think the United States is quietly wanting to build reserves, blaming Saudi Arabia, but the real reason is they want to secure as much oil reserves as possible. This means oil takes off. It goes back up to $1 a barrel, to $100 a barrel, to $120 a barrel, to $125 a barrel over the course of next year probably. At the very least, it's seen a lasting bottom recently and it should be stabilizing to go higher. The other thing to buy is the US dollar. Buy the US dollar aggressively until the bubble is complete, because it has already begun to create a bubble, as I said in one of my previous videos. It has entered bubble territory, but not the kind of extreme bubble stretch that probably will occur before it eventually bursts, because most of the world mistakenly thinks the US dollar is a safe haven. But no, it's not. At some point, people who are very long the US dollar will recognize that why are we long the currency of a country that's in recession looking towards depression? Why? Oh, yield. But is yield worth it if the currency were to retrace 20, 30%, 50% of its gains of 2022? So at some point that will become the discussion. Or do you stay long the US dollar if the Fed stops hiking? And the economy is getting so bad there that that is a scenario that might not be that far away. So, long US dollars, long oil. I'm starting to buy gold again. I think gold could be interesting here. I love the idea of selling some of the big names that have been so popular over recent years since the bottom in COVID, like Tesla. Great company, terribly way too high price. I like the company, I don't like the price. So Tesla, I think, is probably a sell. Watch for it to break below its recent range. Could mean something for the next 6 months, 12 months, 18 months. Who knows? Something to keep an eye on. I think the whole big tech thing, and it includes them all. Remember when I did that story and that article about, in The Big Short? I did this about 6 months ago, I think. In The Big Short, they said no one thought to short the AAAs. And if you haven't watched The Big Short, make sure you do. It's one of the best training videos of all time. Films. Great actors, great, like the setting, the backgrounds, everything. It's a first-class film. But one of the lines in that movie is no one thought to sell the AAAs. And I wrote an article about 6 months ago, and no one thought to sell the big A, Apple. But we did. Okay, I'm trying to get through here. There is no other side of this economic slowdown. It gets so much worse. We've only just seen the very early stages. It's like you walked into a restaurant, you've seen the menu, you're waiting for the waiter to order. It's like that early in this global economic slowdown. And you've got 3 courses to go. And if you're in some parts of the world, you've got 11 courses to go. So don't think the buy the dip cult is anything other than a cult. Okay? It's nonsense. All right. Thanks very much. I've enjoyed this. I hope you have too. Please leave your comments. Clifford Bennett, Chief Economist, ACY Securities. What did I say? I didn't say, but I alluded to, the Australian stock market will now crash, okay, after a kind of slight bounce on the budget. Oh, Australia's inflation, of course. But again, we forecast this, so it's like it's not news to us. We're like the only people on the planet it's not news to. Inflation hit 6.3%, core inflation 6.1%, I think. Diabolical. The RBA will have to hike 50 points again, or at least hike 25 points for another 20 hikes. Interest rates are going higher as economies crash. What do you think the outcome's going to be? It is not healthy corporate earnings. That's not the answer to that, X plus Y scenario. Protect yourself, play defense, take advantage of the opportunities that are out there and that you have with these wonderful, modern, sort of level playing field setting financial instruments we all have access to. Have a great day. Clifford Bennett, again, Chief Economist, ACY Securities. Have fun.